What's going on? Alex here, and today we're going to be taking a look at the income tax implications of incentive stock options, or ISOs. And specifically, we're going to be closely looking at the AMT, or alternative minimum tax, implications that you will likely need to contend with if you're dealing with incentive stock options. With that said, we're going to be doing a pretty deep dive. We're going to be looking at a few different scenarios and really looking at the mechanics of how AMT works with regard to ISOs. So with that, let's begin. Let's take a look at some background questions first, and I have a little spreadsheet here with some figures, but really it's good to get a background on what we're talking about so that we can have an effective conversation in terms of understanding ISOs, especially in light of AMT. So first, let's understand what incentive stock options actually are. Now, there's really two broad categories of stock options from a tax perspective. One of those is non-qualified stock options, or NQSOs, and those are typically disadvantageous in that the bargain element, or the difference between the exercise price or the strike price and the fair market value of the share, is taxed at ordinary income tax rates. So that's something you want to possibly avoid if you can, because it's going to be taxed at whatever tax brackets you're subject to. On the other hand, you may be granted ISOs, or incentive stock options. The goal there is, once you go through the entire process, including AMT implications and all, there should be long-term capital gains treatment available to you for the difference between the exercise price of the shares, or the strike price, and the fair market value of the shares. So there is a possible tax benefit associated with ISOs, but a huge disadvantage is that in a year in which you exercise incentive stock options, the bargain element becomes an adjustment for AMT purposes. So that bargain element is essentially added to income under AMT, whereas there is no tax effect under ordinary taxes. So what ends up happening is you have an AMT hit in a year in which you exercise a significant amount of incentive stock options. And then you have to essentially get that AMT back in the form of the AMT credit. So it's important to understand that if you have an AMT implication due to the exercise of incentive stock options, or ISOs, then you will, after some time, get most or all of that AMT that you paid back in the form of the AMT credit. Now, that happens once in a year subsequent to the year in which you paid the AMT, your ordinary tax is higher than your alternative minimum tax. I'm going to show you how all this works. We're going to get into the dynamics here, but in very general terms, you will have that difference between the AMT and the ordinary income tax bridged in the form of the AMT credit. And some of it might come back to you in the next year. It might come back in 2 years, but most of it generally comes back to you in the year in which you dispose of substantially all of those shares that you obtained by exercising ISOs. All right. Now, taking a look at the events that apply to incentive stock options, it's important to understand when you have a tax event and when you don't. Now, at the grant date, either for ordinary income tax purposes or AMT purposes, that is a non-tax event. Nothing happens for ordinary income tax or AMT. So you granted the ISOs, everything is good, and then you get to the point where you want to exercise those ISOs. And that's when there is still no implication for ordinary income tax purposes. But the bargain element becomes one of the adjustments for AMT purposes. All right, so a little bit complex. We're going to take a look at this in detail, so don't get flustered if this is a bit advanced for now. But this is just a general overview for us to get a lay of the land and idea of what we're going to be discussing. So what is the difference between a qualified disposition and a disqualified disposition? As I mentioned, incentive stock options have certain holding period requirements that will enable you to enjoy that preferential tax treatment. Those holding periods are 2 years after the grant date. There's another requirement that you have to wait a year after the exercise date to go ahead and sell those shares. So there's those two holding periods. So you have 2 years after grant date and a year after the date of exercise. Both need to be met. It's not one or the other. And if you meet both of those holding periods, then we can talk about the preferential long-term capital gains treatment. And that's what's known as a qualified disposition, in that you met the holding requirements and now you're getting possibly that preferential tax treatment. On the other hand, a disqualifying disposition occurs when you fail to meet either of the 2-year or the 1-year holding period requirements. So that means you sell the stock in less than 2 years after the grant date or less than 1 year after the date of exercise. In that case, your incentive stock options are then treated as non-qualified stock options, and you're essentially going to be subject to ordinary income tax treatment. In a way, you lose the possible tax benefits of dealing with incentive stock options in the first place. So, what is the alternative minimum tax, also known as AMT? Now, there could be college courses on alternative minimum tax in and of itself, but I'm going to give you a very quick, simple overview. Essentially, the alternative minimum tax is a parallel tax system, which means it works alongside the ordinary income tax calculation. You could think of them as two lanes on a road. And on the ordinary income tax side, you have a certain set of rules that apply. And then on the AMT side, you have a different set of rules that apply to calculate your tax liability. And in general, whichever one is higher, meaning ordinary income tax or AMT, you will pay the higher of in a particular year. So AMT is always being calculated in the background. You just may not see it when you look at your tax returns because unless there's an AMT implication, those forms associated with alternative minimum tax do not get included with your tax return. So they're lingering in the background. But when you do have an AMT implication, then those forms all of a sudden are required to be filed, and you will notice them with your tax return. One of those is Form 6251. So let's take a look at an actual tax return so we can understand the dynamics between ordinary income tax and AMT. Looking at a 2018 Form 1040, it's the same as if it was 2019 or 2020. There aren't huge changes in this regard, but initially we have $100,000 in wages on this return and not much else going on. But it's important to note line 10 of Form 1040, and that's taxable income. And you'll see that's $88,000 here. And that number is important because that is the starting point on which alternative minimum tax is calculated. So it takes the taxable income from the ordinary tax side and starts the calculation for alternative minimum taxable income, which is then the amount used to calculate the alternative minimum tax. The alternative minimum tax, keep in mind, has two rates, 26% and 28%. So up to a certain level of alternative minimum taxable income, you're looking at a 26% rate. On top of that, 28%. This is just at the federal level. States have different rules in this regard. So we'll see here that we have the ordinary income tax forms, but we don't have any alternative minimum tax forms. But we can, with the software, take a look at what's going on in the background because, as I mentioned, alternative minimum tax is always being calculated parallel to ordinary income tax. Even if you don't see it, the calculation is happening in the background. And the AMT forms only show up on your return if there's an AMT tax hit in a particular year, meaning that your alternative minimum tax exceeds the ordinary income tax, in which case you pay the difference in the form of additional taxes. So if we look at Form 6251 in this example, this taxable income number should look very familiar because it's the number from Form 1040 line 10. That's $88,000. Then you'll see that the deduction, either the standard deduction or the taxes from Schedule A, which is the itemized deductions, is being added back here. AMT is supposed to punish the fat cats by saying, hey, wait a minute, you're not getting the deductions that a lot of other taxpayers receive because you make too much money. So now we're going to add that back. So this $12,000 is the standard deduction from 2018. It's being added back to calculate alternative minimum taxable income. So you can see all these other adjustments here that are applicable, and we can get down to alternative minimum taxable income, AMTI. And this is the amount on which the AMT is calculated. But first, there's an exemption for AMT purposes that's applicable. And let me just show you here how this all works. All right, so you get down to here, and the exemption is being calculated. So every taxpayer gets an exemption, a certain amount of AMTI on which they're not subject to AMT. So much like there were exemptions on the ordinary income tax side, there are exemptions on the AMT side, but they're different amounts based on your filing status. And we can see here that for single or head of household, if line 4 is not over $500,000, which in our example it's not, then enter $70,300, which we see here. So once we get the exemption, we can calculate the AMT or alternative minimum tax. You see that the tentative minimum tax in this case is $77.22. However, the ordinary income tax, meaning the amount from Form 1040, is $15,416. So the ordinary income tax is higher, which means that in this year, the AMT is 0. Again, AMT has to exceed ordinary income tax liability to make it onto the return and to have an effect from a tax perspective. In this case, the AMT is lower, ordinary income tax higher, so you just pay the ordinary income tax. It's as if the AMT doesn't exist in this case on this return. And we can see that by enabling only the forms that are included with the return. You can see that 6251 is not included. 6251 being the form where we calculate alternative minimum tax. So let's add an AMT implication to this, specifically bargain element from ISOs, and see how things change. In this example, all I did was added $200,000 in bargain element for AMT purposes. And we can see that the tax return on its face hasn't really changed all that much, but we have an additional amount of tax from Schedule 2. Let's take a look at Schedule 2 now, and we can see that this is related to the alternative minimum tax attached form 6251, which we already know. Now we can see that this form is being included with the return, so we take a look at that, and we can see that we start off with the same $88,000 for taxable income from the ordinary income tax side. We have the $12,000 in the standard deduction that's being added to it to calculate AMTI. However, one of the adjustments is also exercise of incentive stock options, excess of AMT income over regular tax income, $200,000. That's that bargain element. Again, the bargain element, not an implication for ordinary income tax purposes, but it is an adjustment for AMT. And you can see that the alternative minimum taxable income now, or the AMTI, is $300,000. Now, if we apply that same exemption amount of $70,300, we can see here that the AMT being calculated is $60,494, while the ordinary income tax amount is $15,416. So the difference is $45,078, and that is the additional tax that you're going to have to pay, which we could see here on Schedule 2. All right, so that's how it all comes together. Essentially, think of it as two parallel calculations, and then once you hit taxable income on the ordinary income tax side, then you also have to calculate AMT, which is always happening in the background. So once you add back all those additional items for AMT purposes, you then get your AMTI, or alternative minimum taxable income, which then is used to calculate your alternative minimum tax. If AMT is higher, then you pay the difference between your ordinary income tax and your AMT. If ordinary income tax is higher, the AMT is not applicable in a particular year, and it's as if it doesn't exist if you just look at the regular tax forms. So hopefully that allows you to understand a bit about how the alternative minimum tax works.